Hello everyone, welcome to another episode where we analyze the financial roller coaster we're all buckled into. Today's video is going to dive headfirst into the market turmoil in the US, and yes, it's shaping up precisely the way every economically conscious observer feared: deteriorating fundamentals, political chaos, and everyone's favorite buzzword, uncertainty. Investors and central banks are scrambling like headless chickens, wondering when the next economic shoe will drop. Does this sound dramatic? Well, buckle up, because if you're relying on a dovish Fed to keep propping up this overinflated stock bubble, it's time for a reality check. Tech earnings were a key pillar of the stock market's resilience in 2024. That's been the case for years now, right? But here we are, by November, the cracks are obvious. After monumental gains for the Nasdaq 100, here's some shocking news. We just saw the first weekly loss in 2 months, thanks to sputtering tech earnings reports that are eroding optimism. No longer can we rely on these behemoths to be the engines driving broader market gains. Meta's struggles with the metaverse are well documented, Tesla's margins are under pressure from rising competition, and even Apple, long considered invincible, is facing challenges from international trade restrictions. Behind the gloss, these tech companies are seeking ways to cut costs, downscale production, and even delay expansion plans. Tech is no longer the fortress it once was for investors because of one crucial component missing from the equation: macro stability. Is this the fallout of tech companies being overly reliant on easy money policies to prop up their earnings? Most definitely. The Federal Reserve's artificially low interest rates buoyed the mass expansion of large tech enterprises. And now, the tables are turning. Now, let's not breeze past the bond market, because that too has been caught in the whirlwind. Bond markets and equity markets have long been two sides of the same coin, reflecting the careful balance between safety and growth. For almost 20 years, we saw bond yields rise in conjunction with strong equity gains, a rare period of synchronicity that last occurred before the 2008 financial crash. Well, as of November, that complementary rise came to a screeching halt, compressing yields and souring those safe haven dreams investors used to fantasize about when stocks plummeted. Treasury yields. Oh, they're shooting sky high. Investors anticipated a stronger fiscal policy that would, in theory, minimize inflation, but instead, we're seeing volatility in hedging instruments break out across the board. We have the Market Volatility Index, VIX, spiking, and even the bond market, traditionally known as the stalwart bulwark of economic positioning, offering little refuge. Bank of America's cross-asset risk gauge just hit its highest pre-election level outside of the 2008 financial crisis. Tell me this, dear viewers, is this what you'd call a well-balanced, orderly global economy? Let alone the volatile price action in treasuries. Goldman Sachs and Barclays have been urging clients for weeks because the risk is just too high. What's interesting to note here is that, historically, when bond markets and equity markets simultaneously falter, it's usually an alarming warning of oncoming, deeper pitfalls, not temporary volatility. But there's more to this than just market mechanics. It's political, deeply political. Next week we'll witness that drama unfurl on the world stage. While we've been watching the Trump versus Harris battle unfold, speculation runs rife. The stakes are incredibly high because each camp has highly divergent views on how to handle this economic crisis. With polls showing a dead heat less than a week before the vote, fiscal policy uncertainty is creating a noisy backdrop for investors trying to make sense of the volatility. It gets murkier. The direction of the U.S. equity market seems to be at least partially tethered to these electoral uncertainties. Let me remind you about the so-called Trump effect we're seeing again: a tech surge, Bitcoin skyrocketing upward by 65% in 2024, and suddenly commodity-driven stocks rallying as his odds improve. The relationship investors have right now with the former president's policies borders on hysteria. This politically charged era continues to distract from the more profound underlying issue: no matter who wins, inflationary pressures are still boiling over. Even if investors hedge their portfolios like Morgan Stanley's Jim Caron suggested, the runway for economic turbulence might extend well into 2025. All eyes are pinned on the Fed now, volatility may just get far worse. The economy showcased its enduring resilience earlier in 2024, with solid GDP growth apparent in Q3. Yet this seeming brightness immediately cast a long shadow of worry when inflation numbers trickled in hotter than expected. The U.S. economy has been expanding, but this growth is coming without meaningful alleviations in inflation. This reflects decades-long symptoms of lazy fiscal management which treats momentary stock market booms as symbols of underlying strength, when, in reality, it's more akin to lipstick on a pig. Central banks provided seemingly limitless liquidity to sustain market euphoria after the pandemic, but hardly anything was structural. The recent bout of inflation is a direct reflection of this. The explosion of fiscal relief combined with incessant government spending has made inflation baked into every aspect of the economy. Bear in mind that the U.S. Federal Reserve's balance sheet is still hovering around $8.5 trillion, a staggering number, especially since it's over $4 trillion more than pre-pandemic levels. Federal debt itself, currently clocked around $33 trillion in 2024, and looks to grow. The endless cycle of debt issuance to finance fiscal deficits is what's driving yield volatility in the bond markets right now. Both Trump's fiscal extravagance and Harris's promise of further social spending contribute little to taming inflation. It's simply a dream that either side can address these deeper structural problems without completely upending fiscal policy. Let's be clear, this isn't just an economic consequence, it's systemic malnourishment. Now, before anyone hits the panic button, let's take a look at what you, the informed investor, should be considering as we navigate 2024's endgame. Volatility is here to stay for the medium term. As Rich Weiss mentioned, we are in for a damned if we do, damned if we don't scenario with inflation. If Kamala Harris wins, progressive policies could push fiscal spending even further, necessitating another round of significant hikes by the Federal Reserve to combat inflation. Think of it as monetary tightening on steroids. On the other hand, Trump's victory could create a frenzy in the markets, as bets on reintroduced tax cuts and inflationary policies could force central bank reactions that further destabilize already fragile sectors. That triggers more bond volatility, and then well, we're staring at a possible market taper tantrum redux, just on magnified levels. Market strategists from J.P. Morgan Chase have wisely pointed out that equity positions have been scaled back among investors harboring the same concerns. Hedging strategies are increasing across the board, including measures in the commodity sector, precious metals, and cryptocurrencies. Moving forward with your investment decisions means being laser-focused on risk management. It entails treading lightly with high-risk assets like equities in sectors that could see pronounced disruption. Technology is no longer a safe haven due to reliance on leverage. Portfolio diversification will be the key to surviving this volatile period. But most of all, policymakers, voters, and investors alike must face the elephant in the room, the structural fragility of our global economic system. The simple truth is, you can't base an entire economy on speculative bubbles and aggressive monetary easing. In a stock market where 23% year-to-date returns are considered normal and Bitcoin's 65% run-up this year makes more headlines than inflation, there's clearly something off. Let me wrap up by saying this: 2024 is not 2007, and we won't get a 2008-level financial crisis out of this, yet. But what we will get is sustained, nerve-wracking volatility with markets and economic stability hanging on by a thread, whether it's dictated by political antics, inflation, or fragmented fiscal policies. Central banks are under immense pressure from the inflationary policies set forth by political grandstanders who have no real solutions beyond short-term gimmicks. It's time to be cautious, time to control your risk. As always, we'll continue breaking things down for you, so stay tuned for more hard-hitting takes designed to cut through the political noise and market distraction. This storm isn't over, so be smart with your investments and keep walking the tightrope. Make sure to like, comment, and subscribe. And remember, your wallet never lies. Till next time.